All right, hello and welcome to the AgriCharts and Daniel's Ag Services 2013 Soybean Outlook. Glad you can join us today. My name is Craig Turner, and presenting with me is Drew Wilkins. And there's our pictures right there. First, I just want to get through the risk disclosures. This material is conveyed as a solicitation for entering into derivatives transactions. This material has been prepared by a Daniel's Ag Services broker who provides research, market commentary, and trade recommendations as part of his or her solicitation for accounts and solicitations for trades. Daniel's Ag Services, its principals, brokers, and employees may trade in derivatives for their own accounts or for accounts of others. Due to various factors such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical versus fundamental market analysis, and other factors, such trading results may result in the initiation or liquidation of positions that are different from the contrary and opinions recommended contained therewithin. Past performance is not necessarily indicative of future performance. The risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leverage positions and must assume responsibility for the risks associated with such investments and for their results. You should carefully consider whether such trading is suitable for you in light of the circumstances and financial resources. You should read the risk disclosure accessed at danielsagservices.com. Daniels Ag Services is not affiliated with, nor does it endorse any trading system, newsletter, or similar service. Daniels Ag Services does not guarantee or verify any performance claims made by such systems or services. Thanks for bearing with us on that. Again, my name is Craig Turner. I'm a senior ag market consultant for Daniel's Ag Services, also contributing editor to Grain Analyst, and I write my own newsletter called Turner's Take. And with me today also is Drew Wilkins.
As Craig mentioned, I'm Drew Wilkins. I'm also a senior ag market consultant with Daniel's Ag Services, as well as a contributing editor to Grain Analyst. I was a previous author of the Wilkins Ag Wire, and we basically folded that into Grain Analyst as part of the daily report. We thought it would be much better at Grain Analyst with the things that come along with it. So that's where the Wilkins Ag Wire comes in. So with that said, let's get right into the presentation here. The first thing we're going to take a look at here is the bull case for the soybean market. And as you can see there at the bottom, the main things we got right now from the bullish point of view is tight stocks and also the potential for a weather market. So with that said, let's jump right into this. So as mentioned, old crop beans are extremely tight right now. You've got record high basis levels, positive crush margins. I mean, for example, you take a look at crush margins. Right now you can buy a bushel of soybeans for about $14.78. After you crush it with meal and turn it into meal and soybean oil, you can turn around and sell that meal and soybean oil for about 28 cents more than you paid for that bushel of soybeans. So when you see or hear about positive crush margins, that's what that means. And that is why the demand for soybeans is pretty strong right now and why you're seeing a record high basis. You've also got South American logistical issues. That's been one of the themes so far, other than wet weather during planting time, is South American logistical issues. There have been wait times of 50, 60 plus days for ships to get in and get loaded with soybeans and get out on their way to their destinations across the world. So the bottleneck logistic issues in South America is not helping the tight supply issues we currently have. You've also got high meal demand and reports of crushers paying $1.35 over July soybeans. As we discussed earlier, crush margins are positive. If they're positive, people are going to get their hands on some soybeans. That way they can crush them and sell them for more than they paid for the actual beans. So that is old crop beans are incredibly tight, and those are just a few of the reasons why we know they're tight and the reasons that they are tight. So that said, let's move on to the next slide here. So take a look at July beans here. As you can see, we've been in a pretty serious uptrend here right now, around 14.78 and a quarter. Based on this slide, over 15 is that potential. Definitely have the potential to get to over $15 in July beans due to the fact that soybean demand is inelastic. You've got corn, which has substitutes such as wheat. There's nothing out there that you can substitute for soybeans. So that's one of the main reasons the demand is inelastic for the soybean market. And you've also got the South American logistical issues that we touched on. So let's slide forward here. Take a look at the July-November spread here. As you can see, back in the beginning of May, this market really got explosive. Got up to 259 3/4 last night. You got commercials caught short. You got cash basis, potentially some areas over $1.20 higher. So that's one of the main reasons we've seen this spread explode here. And we've seen it pull back a little today as basis has kind of weakened. But the spread has really been explosive and quite volatile. Next one here, and then old crop will eventually be solved. World ending stocks are going higher. That's evident by the fact that South America produced 30 more million metric tons than last year of soybeans. As you can see on the chart for Brazil's production, you look at 2011 compared to 2012, and you're going all the way up to the 2013 production year. They produced quite a bit more beans this year. Granted, they've got the logistical issues, but that's just going to make their export year a little further, and that's something that Craig will touch on a little more as we get into the bear case. And let's flip it back over to him.
All right. Well, thanks, Drew. It's interesting what you say. We're all about the old crop right now. In the beans, not focusing a whole lot on the on the new crop, which is which would be the bear case. But the old crop is very tight, and we're even hearing that some processors are already have enough beans for the next 4 to 6 weeks. So we'll see what happens here if that starts to tilt towards the bears, or does the July keep on coming out. As far as the bear case goes, we're really talking about new crop. And as far as new crop is long term, what we're seeing and we think we'll see by harvest time is November beans could very well be under $10. And we're going to get into why we think that in these next few slides. Just short term, yes. Everything Drew talked about, the old crop can drag everything higher. Everyone's watching those July beans and what's going on in the cash market. You get the big spikes there. It's, a rising tide lifts all boats. New crops certainly go up. But what we are seeing, and when we kind of step away and look at the big picture, let's talk about what is happening in the soybean market. The more of the longer term trends and what we'll expect for this year. Global export trends, as you can see on this chart, we've been going higher for years, and now we're starting to plateau. And we see soybean production, increasing, throughout the world, and more market share is going to other countries, not the United States. As far as U.S. soybean usage trends, we see here that the usage was going up from 86 to about 2004. And since then, not a whole lot expanding in the crush. That crush has been around 1.5 billion to 1.6 billion, for the past eight years. And the exports haven't been rising as much as we thought. And it's not because export demand around the world hasn't gone up. It has, but the export demand is being met by other countries like Brazil and Argentina and isn't necessarily coming from the United States. So with that in mind, let's go to the U.S. soybean exports. This really seems to be the driving factor here for prices, especially with China because they're the big boy on the clock. And you can see, from 1990 to 2008, we've been going higher. But since then, there's been a production problem. But in the time of that, plateau of the soybean exports, even when more demand was needed by the world, we have taught the world to grow by going into South America and other parts of the world. We have invested in agriculture. We've shown them how to do it. And these countries now have relationships with our traditional buyers, and they're buying from them. And, they always say the cure to high prices is high prices. And this is what we're seeing. And just to give you an idea about it, look at Argentina. The Argentina production has come a long way since 1990. We're going from 10 million metric tons to 50 in the past 20 years. And, what's Argentina going to do as they develop this more and more and improve on their infrastructure? So that's the long term for Argentina. In the short term, they have not been selling. And I think it's a story that has been just really underreported. Argentina beans have not been coming into the market, and these farmers are holding them, or they haven't been getting them out. And we've been hearing something recently about a long export tail coming out of South America. And what that means is if Argentina and Brazil, especially Argentina, aren't selling their beans in the beginning of the marketing year for them, it's going to come at the end. And not only will it come at the end, they're going to have so many beans, because they had so many beans more than last year, it's going to come into the U.S. marketing period. And we're actually have a risk of maybe not seeing 1.4, 1.5 billion in export sales, because some of those sales that traditionally come to the United States to the marketing year will basically be taken from South America. So right now we have a situation in Argentina. It's called the grow and hold. And they're worried about inflation. They're worried about the government. The taxes are high when they actually sell. And if they're worried about their local currency losing value, the best thing they can do is hold on to as much physical commodity as they can. So they're missing out on the high prices now. They're growing and holding, and it's going to add to this long export tail. As far as Brazil soybeans, we've got logistical bottlenecks also contributing to the long export tail. All this means is that they'll have more beans to sell at the end of the season when the United States starts their marketing. We have very few crush plants that have been built in Brazil in the past 10 years. Why is that important? Well, we're going to have 20 more million metric tons produced in Brazil this year than last year, and none of it's going to go into the domestic crush. It's going to go into the export market. And that's just going to compete with the United States even further. So what does this really mean? We're talking about a U.S. soybean season for a new crop where we might look at 78.5 to 79 million acres, which is going to be more. We're probably going to lose some. Corn is probably going to lose some acres of soybeans. Demand looks like it's slowing or plateauing for U.S. soybeans. We have that long export tail we've talked about. It's going to cut into exports. And the ag forum in the USDA, we're talking about 1.5 billion. We've seen numbers in the trade about 1.45 billion. And when you start to add in the amount of beans that are going to be sold at the end of the South American marketing year and realize they're going to be taking away from the U.S., maybe exports are really 1.2 or 1.3 billion, which is really a huge number to add back to the carryout. Now we're going to switch to it. We're going to start now talking about our predictions and what we think is going to happen. And here's Drew to talk about the bull case.
Okay, thanks, Craig. And as we take a look at the bull case here, obviously if you take a look over to the left, you see weather and drought. That is going to be a bullish factor no matter what year we're in. The weather is the ultimate outlier, and as we saw last year, drought can take a market and take it quite high, as we saw definitely as we moved towards harvest last year, and as the drought continued, bean prices really shot up. And we'll take a look just at the drought monitor over here. Much of the Midwest and Corn Belt's kind of been relieved over this spring due to the heavy rains we've had, and although it did keep people from getting out in the fields as early as they were last year, the rain was much needed and really replenished some drought areas. However, as you get over into the plains, there's still some issues. So that'll be something to keep our eye on. And as we talked about that 2012 weather market, let's take a look at that chart. And as you see the two red downtrending lines there, we were heading into June. Everybody was thinking bearish, bearish, bearish. We were trading around $13.50 for soybeans, and this is just a continuous front month soybean chart. As the drought started to creep in, boom, before you know it, we were darn near trading up at 18 in September. So a weather market can really provide some support to the bean market. As you see here, you go from almost touching 13 to 18. That's a $5 difference per bushel. So a weather market can really make a run, and that's definitely one of the bullish factors for the soybean market for the 2013-2014 crop. Let's now take a look at the bear case.
All right, thanks, Drew. Yeah, definitely nothing will get considering the tight stocks and how badly we need the crop. The weather is going to be a big deal on the production side. As for the bear case in new crop, South America going to have 30 more million metric tons this year than they did last year. With a 44 yield and 78.5 million acres, we'll get to our production table, our supply and demand table. But the way we figure it, if we have that long tail on the export tail, we're almost talking a 400 plus carryout, which we haven't seen reported in much of the ag press. But I think you really you kind of have to let the crop come in and be produced. But if we do have a normal weather year, 400 carryout is definitely in the cards, and that's why we're talking about November soybeans with under $10. Here's the drought monitor from 2009. You're basically seeing no drought conditions, and this is what that would look like with those optimal growing conditions. So when we're doing our analysis, we have a supply and demand table, and what this table is basically doing here is, on the top part up here, we're saying we're going to have 78.5 planted this year, which we think is a pretty modest, and then about 77.5 harvested. Now, the important part of this table is what's going to happen with the yields. What if we have a range, anywhere from a 38 yield, which would be very low, to probably 46 would be much higher than anyone's expectations. Right now, the USDA is calling for, I think, 44.5. We're just going to say 44. And let's see what happens. We bring in 125 beginning stocks. We have about 3.4 billion production. Imports doesn't really matter. And we're ending up with a supply of about 3.5 billion, which I think is pretty on spot, with a lot of the analysts out there. 3.4 billion, 3.5 billion, on the soybeans. But the crush, this may be, I think that we will see strong crush this year. We're thinking that, there is a lot of demand for beans. Drew was mentioning how it is inelastic. There are animals that need to be fed. One thing, though, where we really think the numbers are overstated is this exports, and it is because of that long tail in South America, where South American beans may not be coming to the United States to help old crop right now, but as other countries are importing beans, there's going to be a lot more beans coming in from South America and not the United States. So these export numbers, you'll notice, are lower than what the USDA and the Ag Forum was saying, and because of that, we get a much lower total use. And when you add in the total use, our supply pretty much is the same as the USDA right now. The use is much lower, and when you combine those two, you get very high ending stocks. So, if we have a great, just the best growing season and a record year, maybe ending stocks at closer to 500. If it's optimal conditions that we see now, we're at 4. If we start seeing a weather market, if we start seeing stress in the crops because of high temperatures and not enough moisture, or the drought conditions come back, now we're talking 300, 200, getting back to the 150s, below 200 ending stocks if we have below a 40 yield, and that's where you get your $14 and $15 beans. But right now we think we're going to be under 10, 925. 925 sounds right to us based on a good growing season and a good harvest. So here we go. Basically, there is a bull case for beans. We think it's all an old crop right now. When you weigh all the different balls that make up the soybean market, not just for what's happening right now in the market, but what to expect for next year and beyond, there's just a lot more balls in the bear case weighing it down. So even though me and Drew have a bullish, opinion on the old crop beans, the new crop and going forward does look bearish. Alrighty, so we are going to get into what are our thoughts on the market going forward and what producers and speculators can do. But first, let's talk about the NFA webinars and recommendations that we can provide. Because we're registered and this is a webinar, the NFA has regulations discouraging us from sharing specific trade recommendations with you during an event. However, we do have very specific strategies for both hedgers and speculators based on what we're talking about today. We encourage you to contact us to learn the exact strategies employed based on your circumstances and as a trader or a producer. And once again, before you enter any trade, you should know and understand the risks of trading futures and options and spreads. And from there, I'm going to hand it back over to Drew.
Okay, so let's take a look at some of our ideas in the soybean market. And before we get into these ideas real quick, I know you want to pay attention and watch them, but we're using a new presentation tool called Prezi. We decided to go with that over PowerPoint. So if you have any thoughts on it, if you wouldn't mind just typing it in the quick question box there and sharing your thoughts as we close out the webinar here, it'd be much appreciated. But as for soybean ideas, we think that old crop has the potential to spike. And if you remember the July chart that we took a look at and then the July-November chart that we took a look at, both of them are definitely in bullish trends, and we think that July itself, has the potential to trade up to 15, and also the July-November spread has the potential to potentially come off the board at a $3 inverse. So that's something to keep on as we take a look at the old crop here. As you get into new crop, as Craig just said, it's a mirror of what we think as far as old crop. Right now, new crop is trading around 12.20, 12.30, but you're looking at a huge South American crop And if we have a normal growing year in the United States for 2013-2014 crop, we potentially see November beans heading to $10 or lower. I mean, there's multiple ways we can go about this as far as speculative or hedging. One way is just buying puts and selling calls to finance, taking a look at out-of-the-money options. But if you want to talk a little more about that, as Craig discussed, we are registered. We can't get into specific strategies, but we definitely do have some for both speculators and hedgers alike. Just give us a call, and we'd be more than happy to go over with what we're taking a look at and what we're currently advising our clients on.
Yeah, and just to step in there, Drew, real quick, this is NFA rules about, being registered and making recommendations for webinars. It's not that we can't make recommendations or email them out or send them to our email list or our newsletters. It's just really for webinars and videos where these rules apply.
Correct.
Alrighty.
All right, so just to wrap it up here, basically what we went over today, old crop is tight. It's incredibly tight, actually, and it will be so for the rest of the year. It's not like quantitative easing. You can't print more soybeans. They got to be grown, and right now there's just a shortage out of them in the United States. We don't see that changing. Due to logistical issues in South America, you can't really get them here. It's just tough, and so prices will have to elevate in order to discourage people from exporting or importing from the United States. Kind of have to push it to South America. That way we don't run out of beans here. And that comes with the potential spikes. We think that due to the fact that soybeans are in demand, you've got positive crush margins, we think that there's the potential for spikes in both July soybeans and then, of course, the July-November spread that we've touched on. And then let's look at the other side of the mirror, and new crop we believe is bearish. We see prices heading to $10 by harvest. With a normal growing season, 10 or lower is our outlook on new crop soybeans. Weather rallies will cause temporarily price shocks, but we just think that that's another opportunity to sell. So obviously, it's not going to rain every day, but so we will get some weather rallies, but we believe those rallies are to be sold. So now let's take a look at some of the offers we got for you here today.
All right, great. Thank you, Drew. And we're going to just go on here and wrap things up. But what you should know is, we do have a Grain Analyst website. It's www.grainanalyst.com. We have free services and premium services. This is Andy Daniels' product, and he has an insider perspective. It's very insightful to what's going on in the grain markets. He puts that out 2 or 3 times a week. Andy also has his own trades on there. We also have daily grain updates. And we have a Twitter handle @GrainsGuru. It's a very popular product at Daniels, especially for the speculators and the hedgers in the grain markets. Premium service is free for Daniels trading clients. Also, I write a newsletter. It's called Turner's Take. It's a free weekly newsletter. I talk a lot about the soybean ideas that we talked about today. Will be in that newsletter, and it will also have some of our speculative and hedge trading ideas in there. So anyone who does follow the grain, livestock, and energy markets, and on the hedging side for the grains, it does, on the spec side, focus on future spreads, but does have hedge ideas for the grains. Feel free to sign up. You can also follow me on Turner's Take, and we'll be sending some information about that to you after this webinar also. So that is our 2013 soybean outlook. At this time, we'd like to take some questions and answers, and you can certainly contact me and Drew afterwards with any questions. You can also see that we have the phone number up here too. Alrighty, well, thank you for coming, and we hope to hear from you soon.